Welcome to Fin Street. We have with us Mr. Viral Shah, who is the Vice President at IIFL Securities, and he specializes in tracking NBFC sector. Welcome to the show, Viral. Now, to begin with, one of the segment in NBFC which has seen pain is the MFI portfolio. Growth rate has remained healthy, but it's tapered down, while the NPAs have risen massively, especially in H2FY24. So, what's your outlook with respect to microfinance segment?
Yes, thank you, Abhishek, for having me. Within MFI segment, as you mentioned, the growth rate is slowing down because the benefit of low base is actually going off. But whereas the delinquencies or the stress that we are talking about, we are seeing that actually continuing to rise over the last 2 quarters. More importantly, if you look at the stress which is there, the 30 plus DPD, that is rising across most of the states. It's no longer just 1 or 2 states. And this delinquencies have the potential to slip into an NPA over the next few quarters. And that is where I think probably the concern stems. There are few states like Madhya Pradesh, Rajasthan and also Kerala, where the delinquencies have increased around 100 to 280 basis points on a quarter-on-quarter basis in the 4th quarter. So those are the states that we would look out for. Apart from that, the state-specific issues which were being highlighted earlier, which is Punjab, that is also now expanding to the other states. We have talks of the loan waiver, the basically farm loan waiver in the state of Jharkhand, while the historical data suggests that the farm loan waivers do not have as much impact in terms of MFI delinquencies. But at the other hand, we see that the states like Karnataka, there are some specific districts like the Mandya district where there are some local level issues and collection challenges that MFIs are facing. So net, I think we have to be very watchful in this space at the current moment is what I would say.
Well, local challenges do impact the MFI portfolio. We have seen with respect to historical, trend as well, that local challenges are the biggest challenges for microfinance sector. Now, moving on, commercial vehicle sales are expected to decline for FY25, given the fact that, there has been a base effect in FY24 being a strong year for them. So, how do you see the trend with respect to, players in this segment who finance the CVs? Many of them have been diversifying as well.
So within the CV space, again, you correctly pointed out that there is going to be a slowdown. But more importantly, the players which are active in this segment, over the last 2 to 3 years, a lot of them have diversified not just within the vehicle portfolio, but also outside of the vehicle financing portfolio. So for instance, within when we talk of a vehicle financier, we have to look at each of the sub-segments. So for instance, CV will be weaker, whereas PV would be relatively better, of course, slower than what it was last year, but relatively better. So I think net over here, the implications would be that within the vehicle portfolio, there will be some growth slowdown. Now, depending on which players have what kind of levers to drive the growth in the other segments, you will see the overall growth outlook play out accordingly.
The sweetest spot in the non-banking segment is the housing finance segment. We have seen announcement come in with respect to affordable housing under, the Pradhan Mantri Awas Yojana, which should act as a catalyst or booster for growth going ahead. But what I have observed in housing finance segment is that the large players are not growing, the mid and small players are growing. How do you read into that?
So, if you look at, first of all, talking about the recent fillip that the stocks have received is in terms of PMAY scheme. Within this, we have to see how this will be implemented, because the major scheme that actually drove growth historically was the CLSS scheme, the credit linked subsidy scheme. If it comes in that shape and form, it will be relevant and beneficial for these players. Otherwise, it may not be as beneficial. Secondly, coming to your point on growth, see, it's a function of the base also of those HFCs. The smaller HFCs which are there, the base is smaller, and on that smaller base, they are growing faster. In fact, if you look at a lot of the smaller NBFC or rather smaller HFCs, now that they have achieved some scale relatively, they are venturing into the higher ticket size loans. That is what is also putting pressure in terms of NIMs for some of those specific players. And talking of the larger players, I think few of the players also have been over last 2-3 years doing some cleanup in terms of the wholesale loans, and that is what is playing out in terms of overall growth rates.
Well, consumer financing segment, how do you see that? Inflation rising do impact people's ability to spend. So any growth rate concern with respect to players in the consumer finance segment?
So within the consumer finance segment, since last 3 to 4 quarters, we have seen that gradually there has been a slowdown. Rightfully so, basically RBI has been nudging them. The way we are seeing is the implications of, say, inflation, right? The segment that is going to be more impacted in terms of the asset quality perspective is the segment where the customers are marginal customers, where the ticket size of personal loans, for instance, is much smaller. And in fact, one of the data points that came out in the report that we published today was that the non-MFI loans being given to the MFI customers, that is a segment where the NPAs are actually 3.5 to 4 times of what it is for the MFI loans. And within this also, the segment that has grown the fastest is actually the personal loan. So those are the segments where I would be cautious, the smaller ticket size unsecured segments. Talking of the larger ticket size, in fact, it's beneficial at the margin, say if you are either lending a larger ticket size loan or say if it's a consumer durable loan, because you get that benefit of a higher pricing in terms of your growth.
Well, one of the key concerns with NBFCs now has been the liability profile, with banks turning cautious to the NBFC sector. How do you see the liability momentum, playing out for the NBFC sector?
So, what we have seen in last around, I would say 4-5 months is that the spreads for the non-AAA rated NBFCs, they have been expanding. This is primarily driven by 3 factors. One, you have the tight liquidity situation playing out. Second, there is a nudge from RBI that all these non-bank lenders have to shift away their borrowings from banks, and incrementally you have demand-supply gap playing out. And thirdly, also some of these concerns on asset quality and the small ticket personal loans is making some bit of the lenders to these NBFCs a bit more cautious. So combination of these 3 things is why we are seeing that the spreads are widening. What this means is that the incremental borrowing costs for the smaller NBFCs or the ones who do not have the parentage backing, you will see their cost of funds rise further. In terms of, I would say this will also have some implication on growth. People who will incrementally have to rely more on capital markets for their borrowings, they will not be able to, or they will actually have to curtail their growth ambitions depending on how much they are able to tap the market, because you have to fund your loan growth with your liabilities.
So at IIFL Securities, what are your top picks with reference to top buys or top sells that you have?
So we have a positive view on Cholamandalam Finance, on Shriram Finance and on Mahindra Finance, whereas we have a bit of cautious view on L&T Finance.
Thank you so much for your time, Viral.
Thank you.
For more news and updates, all you need to do is follow CNBC TV 18 on all of our digital platforms.